Good evening, students. I welcome you all in this class. This is our capital gain third session. And in the previous two sessions, we have discussed the basic of capital gain, the chargeability, the meaning of capital asset, the meaning of transfer, indexation concept, short-term capital asset, long-term capital asset, section 47 cases also we discussed in last two sessions. Of course, the Manjula J. Shah, etc. also we have discussed. And I also gave some question for your practice purpose or just like in homework. So I'm going to ask that if you are able to solve those questions and we will discuss those questions also. Before that, of course, there would be a thought for the day. But before that, I want someone who is going to summarize the provision, what we have discussed in session number 2 only. Do not summarize session 1 concept, only try to summarize session 2nd concept in very short of time. Like I will give you 5 minutes to explain those provision in a summary form. So who wants to summarize those provision? What we have discussed in session number 2? Anyone? Last time, I guess Priyanshi has summarized those provision wonderfully. Anyone else wants to summarize those provision in today's class? For that, there are some questions. Astha is asking, sir, in section 47, it is written that up to assessment year 24-25 transfer of capital asset other than share, debenture, or warrants allotted by a company under ESOP, under gift or will by any person was not considered as transfer. So here it only means that from now, not by any person, but only by individual HUF. But sir, then what about ESOP, etc. written in bracket? Let me explain you with the help of an example. Look, what was up to assessment year 24-25? The provision says gift from anyone, if whether it's an individual, HUF, firm, etc. If they gift any asset to anyone, that will fall under section 47 and it is not going to taxed. This is going to be exempted transfer. Clear? But even up to assessment year 24-25, there is an exception. If company gifts ESOP to its employee, then this exemption will not applicable. So in that situation, up to assessment year 24-25, any gift by any person to any person was exempted except this case. So this is an exception up to assessment year 24-25. If company provides ESOP free of cost to employee, then this exemption was not applicable. So what happened? We will take the sale consideration in case for calculation of capital gain. So the FMV of these share would be taken as sale consideration and then cost is going to be deducted as per normal situation. So there would be capital gain or loss up to assessment year 24-25. Now from your assessment year, which is applicable 25-26 for your examination in September and January. Now only gift from individual HUF to any person is exempt. Clear? So whatever the provision for every person up to assessment year 24-25, now these are applicable only in case of individual HUF. All other cases, including ESOP. So what were the provision earlier was applicable on only on ESOP gift is now applicable to all gift except gift by individual HUF. Now if company gifts ESOP, same provision applicable. A partnership firm gift any asset, etc. So now all gift except this individual HUF will be solved like ESOP provision, what we have solved up to assessment year 24-25. So in that bracket, it is written just to explain that up to assessment year 24-25, all gifts were exempted, but ESOP was taxable. Now, whatever we were doing up to assessment year in respect of ESOP, the same provision is applicable to all gift except the gifts given by individual HUF. Understood? Okay. Soumya, good evening. So total or partial partition will be regarded as transfer, but being exempt section 47, yes. Again, partition is like relinquishment, but it would be exempted under section 47. Priya is saying, good evening, sir. Can we discuss those M4 MCQ? Definitely after this query, these queries, and then thought for the day, we will discuss definitely those 4 questions. Asta is asking, sir, in reverse mortgage is written where the loan is disbursed in part or in full to annuity sourcing institution for purpose of periodical payments by way of annuity to reverse mortgage. Sir, please explain. So we have explained in detail that any annuity means something which is going to be paid annual. So those institutions like bank, etc., if providing any kind of payment in the form of loan, but it is an annual payment or monthly payment to the receiver, that would not be treated as your income because it would be still a loan. Good evening, sir. Please explain the land and building point in section 47. Why it is that land has to be purchased 2 years before and building constructed within 2 years. Why nahi? It could be a possibility. There could be a case in which you might purchase the land 2 years before and construction has been completed later on. So suppose you have purchased a land in 2020 and transfer it in 2024, but you start making construction on that land and that construction has been completed in 2023. So I have told you that if in that situation you have given separate sale consideration for land and building, then you have to solve that question in separately. The land would be the long-term capital gain and the building and construction part would be treated as short-term capital gain. Harshdeep wants to summarize last session. Very good, Harshdeep. I will ask you to summarize that. Just let me take some queries. Okay, all queries has been done. So yes, Harshdeep wants to summarize the provision of last session. Can we unmute Harshdeep? Maniji, please unmute Harshdeep. Okay, Harshdeep, please continue.
Good evening, sir. It's Harshada.
Harshada, oh, sorry. Okay, yes, Harshada.
Okay. So actually, as you have discussed or explained already, that is a capital. Where the capital gain is concerned about the capital assets and the transfer, which are the basic criteria for this capital gain calculation computation. And after that, we have learned about the cost of acquisitions regarding goodwill, shares, and others. So should I explain all the for the shares that before
Summarized form. The basic things we have discussed in the last session. Like you just discussed in the last session, we have discussed the provision regarding right share cost of acquisition,
right?
other assets. So
Okay.
basically provision you can summarize, not an issue.
Okay, for ordinary shares, on or before 1st April 2001, we need to, if before 1st April 2001, we need to consider FMV or purchase price, whichever is higher. And after that, we need to consider the purchase price for calculation. For bonus share, the same thing. But for bonus share, it's after 1st April 2001, it will be nil. Cost of acquisition will be. And for rights share, there will be two bifurcation, old shares and the new shares. If we purchase old shares, then purchase price is on or before, then on or before 1st April 2001, then FMV or the purchase price, whichever is higher. And if a right renounce for the old share, then cost of acquisition will be nil. Before means after 2000, sorry, for right renunciation for old shares. And for new shares, if we are directly purchasing from company, then it will be market price. And in case of a right plus renunciation, then new shares, we have to pay right renunciation cost plus price to the old shares or shareholders. And in case of other assets, it will be like if on or before 1st April 2001 FMV or purchase price whichever is higher, and after 1st April 2001 purchasing price will be the price we will consider for cost of acquisition. And immovable properties FMV or the stamp duty or the purchase price whichever is higher, because in FMV
Lower. FMV or stamp duty value, whichever is lower. FMV
lower.
should not exceed the stamp duty value.
Yeah, right. Stamp duty should not, sorry, FMV should not exceed the stamp duty.
Correct.
Okay.
Okay,
Then
now
there is a
explain
special.
section 47. Now explain
Okay.
that there are certain transfer, those are exempt under section 47. So you just need to explain what are the treatment, like what we will do as a cost of acquisition and period of holding, and what index we need to take in if the transfer as per section 47. That Manjula J. Shah case law, with that
Okay.
in short.
Okay. As per the section 47 of Companies Act, we need to consider period of holding from previous owner's point of view, and cost of acquisition from SSC point of view. The indexation is from SSC's point of view. Cost of improvement before 2001, we should ignore that. But after 2001, we should consider SSC's and previous year.
Previous owner also.
Previous owner, sorry. And as per the Manjula J. Shah case, period of holding, period of acquisition, indexation, and cost of improvement, everything will be the point of view of previous owner.
Correct.
And we have lastly learned the reverse mortgage scheme. That is basically for senior citizens, and which they need to get the loan in form of installments, EMIs, and they need to pay after means once either or survival will, they are not supposed to pay the repay the loan, but after their death their transferee should pay the liable to pay repay the loan. And 14 and 15 is pending, so like today we'll.
Well done. Very good. If you explained wonderfully, that's very good. I appreciate that. Now there are some more queries. Astha is asking, sir, if we get deduction in section 24B or chapter 6A, then while calculating cost of acquisition, these deduction will not be the deducted and full value to be indexed. Correct. If anything which we have already been claimed under any head of deduction or under any head of income already, like interest on housing loan, etc., that could not be form part of cost of acquisition in case of capital gain. This is a universal rule under income tax. No deduction, no benefit can be claimed twice, and no income can be taxed twice. Okay. Soumya is asking, sir, any transfer in scheme of amalgamation, exemption will not be available if capital asset is transferred as stock in trade. Please explain. Yes, if a capital asset has been transferred to the other person in case of amalgamation and the transferee show those capital asset as a capital asset, then exemption is there. But if the capital asset has been transferred as a stock in trade, for the transferee, if it introduced that capital asset as stock in trade, then section 47 exemption will not be applicable and we have to calculate the capital gain. How it's going to be calculated, we will discuss it later in this chapter. Do not worry. Next is indexation of improvement will be considered from previous owner also. If there is a cost of improvement, Priyanshi, on or after 1st April 2001, whether it has been done by the previous owner or the assessee, both required to deduct it with indexation. Okay, only the cost of improvement which has been incurred before 1st April 2001, that needs to be ignored. So now we will discuss the thought for the day. And it says, be stronger than your excuse. So every one of you has suffering from some problem. There are some issues with someone, other issues with someone else. But you have to be focused. You have to be very, very confident that you have to achieve your goal. There's a very interesting saying that if you want to do something, you will find a way. And if you do not want to do something, you will find an excuse. So if you want to be a chartered accountant, just leave the excuses that you were not able to study for last 2 months. There was some function in your family. If you will get 15 days more, maybe you will be able to clear. So these are all excuses. You all have same platform. You all have same time duration for the preparation. Just be strong. Just make sure that you are prepared for your examination. And if you are prepared well, definitely there would not be any excuse. So leave the excuses and be stronger to face the examination. So that was the thought for the day. Moving on to the provision. We were discussing section 47. We discussed those 12 cases, and then we have moved on. Point number 13, that was regarding reverse mortgage. Now there are two more exemptions under section 47, and we are discussing these two exemptions separately because the earlier 12 cases, what we have discussed like amalgamation, demerger, gift, partition, etc. In all those cases, the concept of solving those questions, the practical question solution methods are same. That you have to take the cost of acquisition from the point of view of previous owner, the period of holding from the point of view of previous owner, and of course, the index also as per Manjula Jisha from the point of view of previous owner. Now, in case of point number 14 and 15, concept is going to be changed. There is no concept of previous owner actually. Now the asset is going to be converted. So there is no applicability of those 12 cases what we have discussed. So here are separate provision. That's why we are discussing these points separately. Now point number 14 says that any transfer by way of conversion, of bonds or debenture. So if there is a convertible bonds or debenture you have, and any transfer by way of conversion of bonds or debenture into the shares or debenture of the same company, that is going to be exempted. So if you convert the bonds or debenture into the shares or debenture of the same company, that would be a exempted capital gain. At the time of conversion, that would be exempted. As in case of gift, when you gift that property, it is exempted. So when that is going to be taxable? At the time of transfer of those converted assets. If you convert your bonds into shares, that is exempted. But when you will transfer or sell those shares in the market in future, at that point of time, at that year, that is going to be taxable capital gain. Understand? So you can see in case number 14, there is no change of assessee. There is no change of person. What is changing? The nature of asset is changing. So that's why there is no concept of Manjula J Shah, etc. Because in all those 12 cases, there are owners change. But in this cases, owner remain the same, but the asset is going to be changed. Clear? So section 4710 provides that any transfer by way of conversion of bonds, debenture stock, deposit certificate in any form of a company into share debenture of that company shall not be regarded as transfer. Clear? Now point number 15 says, any transfer by way of conversion of preference shares into the equity share also exempt of the same company. So even if debenture bonds converted into shares or debenture of same company exempted, or preference share is going to be converted into equity share, that is going to be exempt. So now in these two circumstances, in these two cases, how we would going to solve the question that we are going to discuss in next slide. So there are certain clarification, those explain that in these cases, how we will take period of holding, how we will take cost of acquisition, and how we will apply the index concept. So let me tell you again, there is no concept of change of assessee. That's why there is no applicability of Manjula J Shah. In these case, assessee is not changing, but the nature of asset is changed. So now let me explain you with the help of an example. It's a very interesting example. Please be focused. Okay. Suppose there is Mr. A. He has 1,000 convertible debenture, which he purchased on, suppose, 10th July 2015. Clear? Company has a conversion policy. And he purchased them at the rate 100 rupees each. company has a conversion policy that they will provide in conversion of these debenture shares in the ratio of 2:1. That means against 2 debenture, you will get 1 share in the future. So at the time of conversion, suppose the conversion happened on 10th July 2020. The time of conversion where the FMV of shares was rupees 120 each. 50% value, let me change it. Suppose 60% of value of debentures has been converted into shares. So very interestingly, you have to see that 60% of the value of convertible debenture has been converted into shares on the specific date when the FMV was 120 rupees each. Clear? Now in the year, our previous year, 2024-25, on 10 July 2024-25, assessee transfer all shares and debentures at the rate of 300 rupees each. So we have to calculate capital gain in this respect. So first of all, you have to understand that this question, why does not belongs to the all those provision what we have discussed earlier, because there is no change of assessee. And the very important thing that you have to take kept in your mind that what we have received, the ratio, first thing, the ratio is very important, that you have received 2:1 ratio shares against debenture, and the conversion is 60% of value. So now if we going to solve this question, first of all, we have to understand at the time of transfer, what number of shares and debenture he has. So only you will be able to find out the correct sale consideration. Without the correct sale consideration, you are not able to solve the question. So let me show you. Earlier, he was having 1,000 debentures, convertible debentures, and he has purchased them for the value 1 lakh rupees. Initially, he was having 1,000 debenture at the rate 100 rupees each. So total value was 1 lakh. Now, as per the ratio, how many shares he must have received at the time of conversion? Because the ratio was 2:1. So he must have received 500 shares at the time of conversion. Now, a very interesting thing is here. How much value has been converted? The value was 1 lakh and 60% of this value has been converted into the cost of those equity share you have received. So that means the value of these shares now 60,000. And when it happens on 10th July 2020. So on 10th July 2020, now he is having number of shares 500 and the cost for those shares are 60,000. Because of this conversion, now how much cost left with the convertible debentures? Because 60% of value has been converted into shares. That means whatever debenture we are having now, the number of debenture will not get reduced. They will remain the same. Earlier it was 100 rupees per debenture. Now it would be 40 rupees per debenture because you have converted 60% value of your debenture into the shares. So technically now you have 1,000 debenture at the rate of actually 40 rupees because the value is now 40,000 remaining. And you are having 500 shares for the value of 60,000. So in this kind of question, in which there are conversion of debentures into shares or preference shares has been converted into equity shares. First of all, you have to do working to find out how many number of debenture and what is the value I have. Only after finding out the correct number and value, now you will be able to solve this question. So the two very important thing you have to see in the question, that what is the ratio and the conversion of value. So now if you see, I am having debentures, which we have purchased still on 10th July 2015. So I am now having 1000 debenture and the cost of acquisition is remaining now 40,000. 1000. Okay. And now I am having shares which I have received on 10th July 2020. That would be considered as the purchase date, the date of allotment, of course, 500, and the costing is 60,000. If you are able to find out these two things, now the question is very simple, very easy to solve. Now we have the number and the value, so we can easily solve this question because there is no Manjula J. Shah concept is applicable. So how we will solve it? I will always ask you that please write it down the format, that computation of capital gain in the hands of Mr. A for assessment year 25-26. Now we are having two assets, debentures and shares. 1000 debentures, 500 shares. Now, period of holding, if we talk about, so the period of holding for debenture would be from 2015 till 24, long term. And for this 2020, then 24, again, long term. Now, the sale consideration. So we have write it down that 300 rupees per debenture or share, you sold all your security. So this is my sale consideration in case of debenture. Now, the asset is long term. So do I need to do the indexation applicable or not? Should I do the indexation of cost of acquisition? What is my cost of acquisition in this case? The cost of acquisition is only 40,000. There would be no indexation of cost. Why? Because in case of debenture and bonds, there is no indexation concept applicable except that capital index bond and the government bonds, what we have discussed in the short-term, long-term cases. So in normal debenture and bonds, there is no indexation applicable. So this would be your cost of acquisition. We are going to deduct it from the sale consideration. This would be your long-term capital gain. That means 2,60,000. Now in case of shares, we are having 500 shares. So the sale consideration would be 1,50,000. Now we are having cost is 60,000 and we will do the indexation in this case. The index would be 363. And for the purpose to divide this value, we need the index value of 2020 and 21. That would be given in question, whatever it would be, you need to reduce it. And that would be my, again, long-term capital gain or loss as the case may be. So in case of these two exempted capital gain, when there are conversion question, you have to identify the number of debenture shares left at the end after that application of ratio and the value remaining after that conversion part. So that's why everything has been written in the notes to make you understand these concepts. So clarification for these two cases, the cost of acquisition of shares or debenture received, that means the converted asset you received, shall be the cost of that part or debenture or bond which is so converted. So the cost for the new asset which has been received by us, like in the example that was shares, would be that part which has been converted. Clear? The period of holding would be from the date of allotment. There is no special case in this case. The period of holding would be start from the date of allotment. That means new period of holding. If the preference share converted into bonds or debenture, that would amount to transfer and capital gain will arise. If preference shares converted into equity shares, only in that case exemption is there. If preference shares converted into bonds or debenture, that is going to be taxable. So those were section 47 concept we just finished. Miss Tannu is asking, sir, debenture ही तो convert हुए हैं, तो debenture why we take 1000? Because debenture की value convert हुई है. That's why I highlighted that concept. That is the mistake what generally student does in the examination. What they do, students do this mistake that they convert 60% of number of debenture. They assume 1000 debenture, now 60% converted. So remaining debenture are 400. No, question specifically says value converted. For the purpose of conversion, ratio has been given. So number of debenture will not change in this example because we have converted the value of debenture. Understood? That's the main point of this kind of question. This is the mistake generally students do in examination. So you have to take care of it. Dhanush is asking, sir, why indexation not applicable? In case of bonds and debenture, indexation does not applicable. If you go through with the notes, the indexation part, the clarification regarding indexation. The first clarification was cost of improvement would be considered only on or after 1/4/2001. I guess second or third note regarding this concept, which says there is no indexation in case of bonds and debenture except capital index bond, etc. You can go through that, okay? Now, the next topic is advance money forfeited under section 51. So generally, in some cases, it can be happen that if you enter into an agreement to purchase a property, land, building, etc. In land and building cases, generally it happens. This provision is applicable for all kind of asset, but in generally, if you're going to buy a land or a building, what happens? You need to pay some amount as an advance money, and the remaining would be paid at the time of registry. So at the time of agreement, you might need to pay 1 lakh rupees in advance. And in the agreement it has been written that you have to pay the balance amount within 5 months, 3 months, 6 months, depend on the circumstances. And if you won't be able to pay that amount, the advance money may be forfeited by the assessee. Suppose it happen, I am going to buy a property of 50 lakh rupees. I have given 5 lakh rupees in advance and I promised to pay balance within 3 months. And I won't be able to pay that amount. So that the seller forfeited my advance of 5 lakh rupees. So what happened? Up to before 1st April 2014, before 1st April 2014, the provision were different in case of advance money forfeited. And on or after 1st April 2014, the provision has been changed. So the new provisions are very simple. If you forfeit advance money in case of any capital asset, that would become your income from other source in the year in which you forfeit that amount. There is no impact on capital gain. So the treatment would be under income from other source directly. It's very simple. But before this date, that means up to 31st March 2014. So if you have forfeited any advance money up to 31st March 2014, then there is no treatment under income from other source, but the treatment need to be done under capital gain. Suppose in 2013, you went an agreement to purchase a property for 10 lakh rupees. You paid 1 lakh rupees as advance money. Now what happened? You won't be able to pay that. So this money has been forfeited by assessee in 2013 only. So there would not be any treatment because this is the case of before 1st April 2014. No treatment in income from other source, no treatment in capital gain. The treatment in capital gain would be in that year in which this property is going to be transferred. Suppose now in 2024, this property has been sold by assessee to someone else for 100 lakh rupees. Sale consideration 100 lakh. Suppose the cost of this property was 6 lakh. The assessee purchased for 6 lakh. So what will happen? If the advance money has been forfeited before 1st April 2014, so if you transferred that property in previous year 24-25, so out of the cost of that property, the advance money forfeited by you is going to be reduced. So advance money forfeited is 1 lakh going to be reduced from your cost. Now this value is going to be index cost of acquisition. So the treatment was in capital gain earlier. If the advance money has been forfeited before 1st April 2014, then at the time of sale, that forfeit amount is going to be reduced from your cost of acquisition. That was the treatment. So what will happen if your cost will reduce? So your gain would be increased. But this provision has been changed from 1st April 2014. Now there is no treatment in capital gain. as soon as you will forfeit the amount of advance money forfeited, that is going to be taxable as your income from other source. Now the treatment is very simple. So you can go through this. Advance money forfeited to be deducted while determining cost of acquisition for computing capital gain. So taxability is postponed till the actual transfer of capital asset. But now advance money forfeited is taxable under section 5629 as the income from other source. I hope it's clear. So next to section 45.3 and 45.4. Let me explain you with the help of an example. Very simple section. It says, what would be the sale consideration? The sale consideration determination if asset transfer by a partner to its firm. So suppose there's a partnership firm in which a partner is transferring his asset to the firm. So what we should take as a sale consideration? That is going to be explained by section 45.3. And if vice versa, if firm transfer any asset to partner, then what should be the sale consideration as per section 45.4. So only we are going to discuss what should be the sale consideration in these two cases. The period of holding, the cost of acquisition provision would be normal, because if partner is transferring his asset to firm, then the period of holding would be calculated as per the normal provision of the partner. And again, the case of cost of acquisition also. So we are discussing what would be the sale consideration in this case. So the provision says if a partner transfer his asset to a firm, then the sale consideration would be the value which has been entered in the firm's book as a book value. So whatever we will enter in the firm's books of accounts as a book value of that asset, that is going to be the sale consideration for the purpose of capital gain in the hands of partner. When firm is going to transfer any asset to the partner, then the fair market value of that asset is need to be considered as sale consideration for that transfer. So if partner transfer to the firm, the sale consideration would be book value. If the firm transfer to partner, the sale consideration would be the fair market value. As simple as that. Dhanush is asking, sir, amount is forfeited. Why we should reduce cost of acquisition? It is the provision, Dhanush, because you have forfeited someone's amount. So you have now extra 1 lakh rupees. So that extra 1 lakh rupees, income tax is going to reduced from your cost. So your 1 lakh rupees gain would be automatically increased. Suppose the sale price is 10 lakh. Clear? Your cost is 6 lakh. You have forfeited 1 lakh rupees of someone. So normally out of that 10 lakh, if 6 lakh reduce, your gain would be 4 lakh. Then 1 lakh, whatever you have forfeited, that is not going to be taxed yet. So what income tax did? They reduce your cost by 1 lakh. So now your cost would be 5. So automatically your gain would be increased by 1 lakh rupees. So that is going to be taxable earlier. And on or after 1/4/14, this has been abolished. Now very simple, whatever you will forfeit, that is going to be taxed as income from other source. Omkar is asking what is the logic behind this date of 1st April 14. So do not ask the logic. You cannot ask why law has been made, why income tax is there, why sale consideration is called sale consideration, why indexation is there. So that is not possible to explain the logic behind this date. The logic is this: from this date, amendment has been made. Before that date, the old provision was applicable. Okay, so we cannot explain the logic behind anything. Priyanshi is saying, for example, 500 at the rate 120. No, that is the FMV we need to ignore. FMV does not have to do anything with the value. That is just to make you confused. The FMV makes you to understand that it is not mandatory that every information need to have something to do in your examination. So that FMV is just irrelevant. There is no use because the cost against which you have converted. The debenture cost 60% converted, that would be your cost. The FMV is given in question is irrelevant. That would be 120, 130, 140. There is no use of FMV. 60,000 is just matched because we have taken 60% of that value. That is just a coincidence. You can take that FMV is 140, 150, 130. Still the cost would be remain 60,000. Okay. Let me change this FMV. Suppose the FMV is 150. Okay. Even still, the cost would remain the 60,000. So that FMV value is just by coincidence, it is same 60,000, but it does not mean that we are taking due to that FMV, the value is 60%. Okay. In previous example, index cost of acquisition taken for shares is index cost. Yes, on shares, it is applicable if it is transferred before 23rd of July. If it is long term, that is applicable. Okay. Ishan is asking, sir, 1 lakh forfeited will not have same value in the year we purchase the asset. So why we directly reduce 1 lakh? After deduction, it will go for indexation also, Ishan. But and that is the old provision. And please do not ask students why. We cannot question the law why. If you are going on a road and some traffic police stopped you, and if they ask why you are not wearing a helmet, you have to be fined. Then you cannot ask, why should I wear a helmet? It is my head, it's my Activa, accident would be my, I will expend all the expenditure on medical. So I am not want to wear a helmet. You cannot say that. So again, we cannot ask why that kind of law is there. Okay. सौम्य asking sir concept के लिए आपके notes remember करें या सारांश book भी पढ़नी होगी, please tell me. सब करो बेटो, सब कुछ मत छोड़ो. You have enough time. Notes and study material are everything in detail. Saransh is just for a summary and for revision purpose. But for detail purpose, you definitely have to refer the notes and the study material. Okay. Sure. Moving on further. Section 45.3 we discussed. It says transfer of capital asset by a partner to a firm shall be chargeable to tax in the previous year in which transfer took place. The main concept, what should be the sale consideration? The amount recorded in the book, the amount recorded in the books of firm will be deemed as sale consideration. So numerical treatment I also made to make you understand how we need to present that thing in numerical format. So sale consideration would be the book value recorded in the books of the firm. Cost of acquisition, index cost of improvement, that would be normal. Next is when firm transfer to its partner. So transfer of a capital asset by a firm to its partner, member on dissolution or otherwise of firm AOP, BOI, etc. shall be chargeable to tax in the year in which transfer took place. The main thing is FMV would be treated as your sale consideration. Okay. Now section 45(1) is having some exception. What are the general provision? The general provision section 45(1) says that in the year transfer took place, we calculate capital gain. If it is not exempted, that was a different case. So if capital gain is not exempted, then that is the normal case that in the year of transfer, we have to calculate the capital gain. Section 45, charging section also says this, that if there is a capital asset and if there is a transfer, then we have to calculate the capital gain in which transfer took place. Clear? Transfer took place. Except or those exempted cases, because in those cases, transfer not regarded as transfer. So we calculate capital gain in the year in which asset has been transferred. But if the capital gain is not exempted, then you have to calculate the capital gain in the year of transfer. But there are some exceptions. There are some exceptions which says that even if there is a capital asset, there is a transfer, we have to calculate the capital gain not in the year of transfer took place. We need to calculate the capital gain in some other year. Even it is not exempted still, because there is a problem. Why? Because there is a general and specific problem that in these cases, you cannot charge the capital gain in the same year transfer took place. why and how. This would automatically, you will understand when we will discuss these cases one by one. You have remembered in transfer definition, there was first point that was sale, exchange, relinquishment. The second one was extinguishment. And I guess the third one is compulsory acquisition, section 45(5). And I told you that we will discuss that later. And after that, section 45(2) was there, conversion of capital asset into stock in trade. So those section 45(2), 45(5) we are going to discuss over here because these are exceptional cases. And of course, exceptional are important also. So it says any profit or gain arising from the transfer of a capital asset affected in the previous year, other than exemption covered under this chapter, shall be chargeable to income tax under this head in the previous year in which what transfer took place. Following are some of the exception of this case. Okay, so before exception, we need to discuss the homework I have allotted to you in the last session. Okay, so I guess you all are ready, and I guess you must have tried that also. So let me see how many of you have tried to solve that and you got the correct answer. Are you all ready? So that was, I guess, question number 9 was the first question. So Harshada is saying yes, sir. So Harshada, can you tell the answer of question number 9? So what is the correct answer? What is the correct option of that question number 9? Okay. Priyanshi is saying B. Harshada is saying B. Ishan is saying B. Soumya is saying B. Tanu is saying correct B. So Sangeetwani is B. Yes, B is the correct answer. So if you are able to find out the correct answer is B, that's very good. Let me show you in short what should be the things you must have calculated in this solution. The period of holding, etc., you must have done yourself. Fine. So I'm just going to show the basic thing. The sale consideration you must have taken 50 lakh. The index cost of acquisition you must have indexed 2 lakh multiplied by 363,100. So that would be 726,000. And the gain should be 4274000. So now I'm just giving you in homework only those cases, those is before 23rd of July 2024 transfer. So after today's class, in the next session, we will also solve some question in which asset has been transferred on or after 23rd July 2024. So in that situation, we have to solve the question twice. One without indexation, one with indexation. Okay. So very well done, students. We have solved this question. Now the question number 10. What is the correct answer of question number 10? Okay, so the correct answer of question number 10, Ishan is saying A, Soumya is saying, Soumya is writing answer 732, but saying option B. It's option A, Soumya. You might have written the wrong answer. Okay, Harshda also saying A, of course. Nidhi is saying, okay. Nidhi is saying C. No, C is not the correct answer. The correct answer is, of course, option A. That is 7,32,000 is the correct answer. This is the correct answer, students. Okay. Now, how we arrived at that answer, let me show you with simple calculation. So in this question, the sale consideration was 30 lakh. 3% expenses on sale, so that would be 90,000. My net sale consideration 29 lakh, 10,000. Now the indexation would be of 6 lakh, multiplied by 363 upon 100. So that would come 2178000. The remaining would be the answer. 7,32,000. So those who did not try it or not able to solve it, you can see that the answer has been derived like this. Next question. Question number 11. The correct answer is, okay, option B. Soumya is saying 27,40,000. Harshada also saying the same. Ishan is also saying the same. Soumya is also saying the same, of course. The correct answer of question number 11 is, of course, option number B. Very well done. Let me show you the solution in short. The sale consideration would be 1 crore. The next cost of acquisition would be 20 lakh into 363 upon 100. So that would be 726,0000. Remaining 274,0000 would be your answer. Well done. Next is question number 12. The correct answer is option number A. Very well done. Everybody is giving me the correct answer. That means you are working really hard to achieve the goal of your life, that to become a chartered accountant as soon as possible. So the sale consideration part in this question would be 50 lakh. Expenses was 1 lakh. So 49 lakh was my net sale consideration. This would be my cost of acquisition. That would be my correct answer. So how many of you feel that capital gain is difficult till now? Do you think capital gain is a difficult topic till now? What we are discussing till now, is it a difficult topic or is it easy till now? So if you are having interest in any subject, that's I told you in my first class. If you are interested in income tax, if you are interested in anything in your personal life, professional life, that thing you will feel easy. So if you have created your interest in income tax or in any subject, you will always feel that subject very easy. And you have to create interest because that will make things easy for you. How you can create interest? Because you should understand only this is the way through which you can achieve your dreams. So you dream it, you plan it, you do it, and you get it. So if you dream to become or to earn money, if you dream that you need to buy a very luxury car, if you dream that you want to travel the whole world, for that you need money, if you dream for reputation, so between that dream and you, there is only hard work. And if you start creating interest that whatever I am reading, that is to achieve my dream. So you will feel that it automatically create interest on those subjects or your study. And that would really make things easy on your part. Priyanshi is saying capital gain and income from house property easiest, sir. No, in my opinion, PGBP is the easiest thing. Let me tell you, PGBP is the easiest topic, whether it's comparison to a salary or capital gain. Not house property, of course. House property is always house property. Other sources are, of course, very tiny topic and they are easy. But in comparison to capital gain, salary and PGBP, PGBP is the easiest. उसमें कुछ है ही नहीं. Already accounts का सब knowledge है आपको. You know what is meaning of sale, depreciation, salary, payment, everything you already knew. They just need to explain very easily, and that is the easiest chapter, I believe, PGBP. In all of these three major heads of income, PGBP is easiest. Okay. Chalo. Moving on to the provision. So we were discussing those exceptions in which there is a transfer of a capital asset, but we are not going to calculate the capital gain in that year. We are going to calculate the capital gain in some other year, and there is some genuine reason why it's happening. The first case is conversion of capital asset into stock in trade. So if you are having a capital asset and if you convert into stock in trade of yourself. You are not transferring it to someone as a stock in trade, but you are converting that capital asset into your stock in trade. So in general, I can say something was in your balance sheet earlier was in fixed asset, and now you want to move that from fixed asset into your inventory part. So that means conversion of capital asset into your stock in trade. How it happens and what is the implication? Let me show you. So suppose there is Mr. A and he is a doctor. He purchased 3 buildings, 3 houses, whatever you want to understand, at the rate 20 lakh each on suppose 10th September 2012. So these are his fixed asset because he's a doctor. So these would be treated as his fixed assets. Okay, so it is a capital asset technically till this date. Now suppose he start a new business. He started a new business and he became builder. He say, I will sell and purchase property now also. So he's doing his practice also, maybe as a doctor or not, does not bother about it. But he started a new business as a builder. And for purchase and sale of property, he thought, why should not I transfer my these capital asset also? So these were capital asset. And he said, why should I buy a new building? First of all, I should start with those building, whatever I have. So he just converted these capital asset, or you can say he introduced these capital asset as a stock and trade of his this business. So that's called conversion of capital asset into stock and trade. So technically what is happening earlier in his balance sheet, these were at fixed asset part. Now they will be as a current asset part in this business, in this new business. Okay. So now this conversion is treated as transfer. As per definition of transfer, you have seen that conversion would be treated as transfer. And this happened, suppose on 10th September 2018. So now income tax says, okay, there is a capital asset, first condition of section 45, and there is a transfer. So section 45, both condition has been fulfilled that when there is an asset and when there is a transfer, there would be capital gain chargeability automatically. Section 45 applicable again. That means capital gain calculate karna padega. At the time of conversion, the FMV of these assets were suppose 60 lakh rupees each. So total is 180 lakh. And the cost was 60 lakh. Forget about the indexation right now. If we generally calculate the profit would be 120 lakh. The time of conversion, if you calculate the profit, ignoring the provision of indexation, that would be around 120 lakh. Clear? Now what will happen? If you suppose the tax rate is 20% on long-term capital gain, then there would be approximate a tax of 24 lakh rupees. Forget about the surcharge and cess. We are just trying to make you understand what is exactly happening. So technically, as per section 45, now there is a capital gain, and according to that capital gain calculation, there must be a profit of 120 lakh, and their assessee is liable to pay 24 lakh rupees tax. Now what happened? The next day income tax came to the assessee and asked, okay, congratulations, you have capital gain. So you have to pay us 24 lakh rupees tax. Does that doctor or assessee really have actual cash flow of 180 lakh rupees? Is there any real cash flow of 180 lakh rupees out of which he can pay 24 lakh rupees tax? Is it possible practically? He just changed the nature of asset. Whatever was his fixed asset, he converted into a current asset. Due to that change, There might be profit in the books of accounts as per the provision, but there is no real profit actually. So as per the capital gain, everything has been fulfilled. There is a capital asset, there is a conversion, and that is treated as a transfer. So section wise, there is capital gain. And according to section wise, if you're going to calculate the capital gain, there would be approximate 120 lakh and tax would be approximate 24 lakh. But there is no real cash. So if assessees need to pay tax in the next year assessment year, he does not have any tax of 24 lakh to be paid because he does not have any real money in his hand. So income tax lies, yes, he is correct. He does not have any money. And if somebody does not have money, how we will recover the tax? So due to this problem, because in this problem, generally in the year of transfer, you cannot collect the tax from the assessee because he does not have any real cash flow. He is saying, yes, I will pay. Once I will have money, I will definitely going to pay this tax. But right now, I cannot pay this tax. So income tax say, okay, now we change the provision. That's why it is an exception. The provision says, in case of conversion of capital asset into stock in trade, we will assume it as a transfer in the year of conversion. This would be your transfer year. No doubt about it. But because he must not have money at this year, so we are just deferring the collection of tax. The collection of tax is deferred. That means the chargeability of tax has been deferred. According to section 45, chargeable year should be this year of conversion. But because practically it's not possible, so the chargeability year has been deferred. So department say we will charge tax in the year of sale of stock in trade. So in the year when stock in trade is going to be transferred, we are going to charge the tax in that year. Now suppose in our previous year 24-25, on 10th September 2024, so I need to take the date before July because that concept we will discuss in last class. So let's take the date 10th June 2024. 10th June 2024, out of these 3 houses, 2 has been sold. So what we have transferred? We have transferred 2 stock in trade. So only on 2 stock in trade sale value, capital gain and PGBP, business income, both needs to be taxed now in assessment year 25-26. And that would be applicable only in case of 2 houses. If 1 house has been transferred, then cap gain would be charged only on 1 house. Now the real deal is this, how we need to calculate capital gain in this case. Let me tell you, what has been transferred is not capital asset now. The stock in trade has been transferred. But what tax we were supposed to collect in the year of conversion, what we should collect in the year of conversion, that capital gain is now going to be collected in assessment year 25-26. So assessment year 25-26, we have to do 2 calculations. One is for capital gain and one is for business income. Why business income? Because ultimately what has been transferred is stock in trade. Now to calculate the capital gain, you have to understand one thing. Everything has been done from this year till 2018. We should calculate capital gain in 2018. But because there was no funds, we just deferred the chargeability year into 2025-26. The chargeable year is only 25-26. All other provision would be applicable, assuming the transfer has been done in 2018. Please remember this thing. It's very crucial. How? When you are going to calculate the period of holding, the period of holding would be from 2012-2018. Do not write in examination 2024 because the capital asset time duration ended in 2018. After that, it was not a capital asset, it was a stock in trade. And we have to assume that we have to follow all the provision assuming that the asset has been transferred in 2018. Just the year is 2025-26, except that everything we need to take, assuming that the transfer has been done, if the transfer has been done in 2018, then how we need to calculate the capital gain. The sale consideration. Okay, tell me what should be the sale consideration? What? We have transferred two properties. So what should be the sale consideration? Assume that you are not transferring in 2024. You have transferred that in 2018. Correct. The FMV at the time of conversion will be treated as your sale consideration. So 60 lakh for one property. So that means 120 lakh for two properties. Understood? Now again, what should be the cost of acquisition? Of course, there is no issue. The cost of acquisition would be 40 lakh. But now the most interesting thing is there. Generally, what happens? Generally, when students solve the question of capital gain, it becomes an habit that we always multiply 363 over here. The current year index, 24-25. So it is a habit because we are solving multiple questions, and every question we have to multiply with the transfer year. And what is generally the transfer year? 24-25. So we always write it down 363. But what should be the transfer year in this case? The index is not 363. The index is the mean, the year in which transfer took place. So the transfer has been equal to the conversion date. So that means we have to take the transfer year index that belongs to 2018-19. That would be given in question. So I am writing down the year just. So 18-19 index I need to multiply. So that is very important. Generally what we do, we write it down 363. That means your marks gone. So be very, very, very focused on this thing. And the purchase year, of course, the same thing. There is no new provision, 2012-13. You need to reduce the index cost of acquisition, and that would be your long-term capital gain. Now we have to calculate the business income also, because ultimately we have transferred our stock. To calculate the business income, what is the main concept? Sale, purchase, balance is net profit. So what is the selling price? The selling price, we have transferred these stock in trade. That must be given in question. Suppose the question says we have transferred 90 lakh rupees each. So the sale would be 180. And what should be the purchase price? Whatever FMV which you considered as sale consideration for the purpose of capital gain would become the purchase price for the purpose of PGBP, because 60 lakh is FMV. It says if you need to purchase that kind of property for your business, you have to spend 60 lakh. So you did not spend, you just transfer your asset into this business. So the market value which we consider as sale consideration automatically become the purchase price for business income, that is 120. So the net profit, or we can say business income, would be 60 lakh rupees in this example. So if conversion question is here, then you have to calculate the capital gain as well as your PGBP income in this way. I hope it's clear now. So now you must have understand that why in case of conversion of stock in trade, why in the case of conversion of capital asset into stock in trade, why we do need to defer our capital gain year. Why we cannot charge the capital gain in the year of transfer? Because practically we do not have funds. We cannot recover fund from the assessee. Okay. So here are the provision regarding it. You can see a person who is the owner of a capital asset may convert the same or treat it as a stock in trade of business carried on by him as noted above. The above transaction is a transfer. Fine. You can go through with the provision. I have already explained it to you. Let me show you the format. This is the format with the example also. Suppose house purchase in 2012 for 10 lakh, converted in 2016. FMV was 30 lakh and sold for 55 lakh in May 2024. So in this year, transfer year 16, but chargeable year would be May 24. So that would be assessment year would be 25-26. Calculating capital gain, FMV at the time of transfer would be your sale consideration. Period of holding, of course, 12 to 16. Cost of acquisition would be normal, and that will result in capital gain or capital loss. A is the owner of a car. On 1/4/20, he started a business of purchasing and sale of motor car. He treats the car as a part of the stock in trade of his new business. He sells the same on 31st March 25 and gets a profit of 1 lakh rupees. Discuss the implication. Because car is a personal movable asset. So when he transferred it or converted into stock in trade, so there would not be any capital gain applicability in case of that car case. Okay. The second example, X convert his capital asset. You can go through this example also. It is exactly the same what we have discussed earlier. One more example for your homework. You can go through with these examples. If there would be any query, any problem, we will discuss that query in next session. I will also give some more examples today, some more question for your homework purpose, but you have to go through all these illustrations. So that will make you to practice that whatever you are actually learning, you are able to solve these kind of question or not. The second exception, first exception was conversion of capital asset into stock in trade. Now the second exception is destruction of capital asset. So do destruction include in the definition of transfer? And if yes, under which heading it has been included? Who will tell me? Maybe I will explain each example, test your knowledge question, everything. But I just wanted that you should try first yourself. That will boost your confidence. If I will solve them with you, so that would you won't be able to understand that question in that way. So first of all, you should try. If you won't be able to solve, definitely I'm going to solve each and everything in next session. Okay. Tanu is saying relinquishment. Rajveer is saying extinguishment. Destruction has been included in the definition of transfer. The first point was, it says sale, exchange, and relinquishment. In case of relinquishment, we have discussed two cases, gift, etc. And the other one is destruction of assets. So technically it has been included in relinquishment definition. And we also discussed that if there is insurance of that asset, only in that case, capital gain would be calculated. If that is non-insured, we are not going to calculate any capital gain. So in case of destruction of asset, this exception is applicable. Why? Because suppose someone asset has been destroyed in 2024-25 and he claimed for insurance compensation. So what generally happens, it is not mandatory that you will receive the insurance compensation in the same year. It's not mandatory. It's not compulsory. Might be it will take 2 years, 3 years, 4 years, 5 years. So how income tax department will charge or recover tax from you until you will receive that compensation? And we did not know how much compensation we will receive. So until we are sure about the insurance compensation amount, you cannot be able to calculate the insurance compensation and capital gain in this respect. So again, in case of destruction, income tax say we will wait till that year. You will receive the compensation. In the year of receiving of compensation, we will calculate your capital gain or capital loss as the case may be. Okay. So capital gain arising on destruction of capital asset will be chargeable to tax in the year insurance compensation will receive. But period of holding, etc. would be remain the same till the time of destruction of asset. Period of holding would be calculated as in case of conversion. So destruction is equivalent to transfer. So period of holding, index value, etc. that would be on that date destruction happened. Just the year of taxability has been changed. Everything else would be same up to the date of destruction happens. Here you can see the numerical treatment. Transfer year will be the year of destruction, but capital gain will charge in the year money received, asset received. Sale consideration would be money received or FMV of asset received. Cost of acquisition, index cost of acquisition, normal provision would be applicable. Now, the third case, it's very, very important also, and that is compulsory acquisition under section 45(5). So we are still going on those exceptions. Exception one was conversion of capital asset. Exception number two was destruction of capital asset. Now, exception number three is compulsory acquisition of asset under section 45(5). So this is a huge topic. You can say it is having multiple applicability. There are multiple cases in this situation. So first of all, we need to understand the meaning of compulsory acquisition and then the implication under capital gain chapter. So compulsory acquisition means when government acquired your any asset compulsory. Suppose government is planning to make a road, highway, bridge, dam, airport, etc. And in that project, your property has been acquired by the government. In that situation, government will pay you a compensation. So that compulsory acquisition by government will also regarded as transfer. Suppose there's a land, government start building an airport over there, and the land is between that government project area. So you have to transfer your property to the government. Government will pay you the compensation. Clear? So suppose you are eligible for the compensation of 50 lakh rupees. Now here is the problem, just same like conversion of capital asset into stock in trade and destruction, that it is not mandatory that you will receive the compensation in the year in which your property has been acquired. Maybe government acquired your property in this year, but compensation has been received by after 2 year, 3 year, or maybe in part also possible that you will get your compensation in installment. So until you receive the amount, you won't be able to pay the tax upon it. As the same case, you won't have any funds. So in case of compulsory acquisition, this has been a provision that transfer year would be your compulsory acquisition year, but taxability would be in that year in which you will receive the compensation. So that is the concept of compensation under section 45(5). It says if any capital asset is compulsory acquired under any law, then it amounts to transfer and chargeable to capital gain. But what will happen? Chargeable capital gain in the year in which OC or EC is received. Now, OC is original compensation and EC is enhanced compensation, enhance. So if you receive that part of compensation which has been decided by the government earlier, government decided you will get 50 lakh rupees for this property. That is called original compensation. But you think, no, this is not enough. You went to the court against the government. You said this compensation is not enough. I need 20 lakh rupees more. And suppose in the court litigation, you won. Court said, yes, you need to be paid more 20 lakh rupees compensation. So that is called enhanced compensation. So original compensation, which is decided by the government, the time of compulsory acquisition, and if it has been enhanced by the order of court or even by the revision of government by any mode, that is called your enhanced compensation. So taxability of original compensation and how we do need to calculate or taxable the enhanced compensation, that is going to be the numerical part of this topic. And this topic is having various multiple provision. One by one, we will discuss about it. So let's take a break. And after that break, when we will resume, we will discuss this topic. Let me see if there is any query. If there is no query, then we will go for a short break. And there is no query on chat box. There is no query in portal also. So Manish ji, can we go for a 10-minute short break? Okay, welcome back, everyone. So we were discussing the provisions of capital gain, and I believe you must have your copy, tea, etc. So Priyanshi is asking, sir, if no insurance note will be set off in cap gain, if there is no insurance, that would not be regarded as transfer. And if it is not regarded as transfer, so in that situation, there would be no treatment. Okay. So like cost of acquisition, cost of improvement would also be allowed. No. If yes, then what would happen if the improvement is done after transfer as stock in trade? Will this improvement cost be allowed in PGBP? Yes, absolutely correct. If any cost of improvement has been done after converted that asset to stock in trade, then that thing need to be only calculated under PGBP head. There is no matter it would be considered under capital gain concept. So technically, when you convert that asset after that date, capital gain concept is finished. We just need that year of chargeability for the purpose of paying tax. Everything, cost of improvement, would be considered only if that is before conversion date. After conversion, each and everything would be treated under PGBP. I hope it's clear, Mr. Ishan. Good question. Okay. So moving on further, we were discussing the provision of compulsory acquisition. Let me explain you with the help of an example, of course, because practical question, if I will explain you with the help of an example, you would be able to understand the provision automatically. So that's what I'm doing. I'm trying to explain each and every provision with the help of an example. So after that, if you start reading the theoretical provision, you will understand each and every word of that provision. If we only going through the provision and we are not solving any example, I assure you, you won't understand the exact concept or exact provision, what exactly it is. So moving on, section 45(5), that is compulsory acquisition under any law. Suppose here is Mr. Ram. He is having a land, purchase that land, suppose on 1st June 2010 for rupees 10. Clear? Government decided to compulsory acquire that property on 1st June 2020. So this compulsory acquired is transfer under section 247. It includes in the definition of transfer. So that means if it is transfer, so here is a capital asset. Here is a transfer. So capital gain provision automatically triggered. But because you did not receive the funds, so the chargeability here has been deferred. And it is going to be charged in the year in which assessee will receive the compensation. Okay. So in this year, government decide that the compensation will be, suppose 60 lakh. Will be. It is not received yet. Will be. So this compensation we called it OC. That means original compensation, which we will receive later. Now the provision says this OC is going to be taxable. Listen carefully. This OC is going to be taxable in the year in which full or part of that OC is received. A very interesting thing, it says this OC is going to be taxed in the year in which OC is going to be taxable in the year in which part or full OC received. So because in this year, no OC has been received, so we cannot charge that capital gain in that year, even when transfer took place in this year. So we will wait to receive this OC. Suppose on 1/6/2024, out of this 60 lakh, 40 lakh has been received. So generally you might be thinking we need to tax only 40 lakh. We should tax 40 lakh only, but the provision says whether it is part or full, we have to tax it full value in the year in which it is received. So even 40 lakh received, but we have to calculate the capital gain on full value of 60 lakh. Now again, this year, what will happen? Assessment year, we will take 25, 26. All other thing would be taken as transfer year is 2020. So my period of holding from 2010-20. My sale consideration, we receive 40, but we have to charge will full 60 lakh because the provision is this. If somebody now asks why sir is this is wrong. So student, this is the provision, this is the law we have to follow. Practically it happens. Why it is like this? Let me tell you. Practically what happens? If government decides some original compensation and if they pay, generally they pay in one go. Generally, they do not pay this original compensation in installment. So that's why the provision has been made like this. But if in examination, the provision says that he has received partial compensation, even then you have to tax the whole value because the provision says we have to calculate the full value of consideration, whether received in part. Now let's index cost of acquisition. The cost of acquisition would be 10 lakh. Again, the index year is 2020. So what is the index of this year? Let me see once. 2010-11 index we need for the purpose of calculation. We cannot multiply with 363. That's what I told you. But please do not do this thing. Always remember we need to multiply with the transfer index. The 10-11 transfer year index, sorry, 2021 index we need. 10-11 for purchase. The purchase index is 148. And we need 20-21 index for this purpose. And 2021 is 301. So my index cost of acquisition would be 20.34. Now you must have a question in your mind that when I will receive the remaining 20 lakh rupees, because we just received 40 lakh rupees. So when we will receive the balance 20 lakh rupees in future, of course, either they are going to be taxable again, of course not. Because we have considered full value over here. In practically, when you will receive balance 20 lakh, there is no tax treatment in that time. Okay. So this is my long-term capital gain in this situation. Priyansh is asking, sir, one silly question. Why painting and drawing considered differently? We are considering those painting and drawing, those value increase due to time, just like the painting made by Maqbul Fuda Hussain, Leonardo da Vinci, or the famous painting of Mona Lisa. So these paintings value increase via time, the antique painting we are talking about. So on those specific like jewelry, etc. So we just consider those personal asset, those value increase with the time. So that's why painting drawing has been included. You must have asked what is the difference between painting and drawing? That could be a good question. Nobody asked me. What is the difference between a painting and drawing? I am assuming that you all know what is the difference between painting and drawing. I believe that. That's why you did not ask me. Otherwise, I am definitely going to ask what is the difference between a painting and drawing. And might be you think that you know, but I believe most of you do not know the difference between a painting and a drawing. You can Google it. What is the difference between painting and drawing? Clear? Not 148. Why? Because financial year 10-11 index is 167. Correct. Financial year index is 167. So let's make it 2009. We will correct the question. So now index is 148. Correct? Yes, I have chosen 148. That was assessment year. Clear? Sorted? Fine. So that is the question. So if a normal question has been framed from compulsory acquisition. So that is going to be solved like this. But there's a problem. In the provision, we have seen that there was two compensation. One was original compensation and the other was enhanced compensation. So original compensation is going to be solved like this. But now what happened? Suppose a assessee went to the court and claimed that this compensation is not enough. 60 lakh is less. I need more compensation. So he asked to increase the compensation by 20 lakh rupees more. So of course the department went against that, and then the court decided his judgment. The provision says that suppose if the court order, the final order of the court has been come that yes, there should be EC, the extra compensation, enhanced compensation, increased compensation must be 20 lakh rupees. So this is again going to be taxable in the year the final order of the court has been passed. Suppose the court order has been passed on 1/6/2026. Then this compensation is going to be taxable in assessment year 27/28. The good thing is full value would be treated as sale consideration. One more good news, you do not need to calculate the period of holding in this case, because this is the same asset for which we are just getting extra amount, just extra amount. Suppose the compensation value is suppose 30 lakh because the remaining was 20, because we received 40 out of 60. So you might not get confused that this remaining you are receiving. No, that 60 lakh we have done. This is extra 30 lakh you are receiving. So this is separate from that balance 20 lakh. When the balance 20 lakh has been received, that is has no treatment because we have already included this 20 lakh in this 60 lakh value. So this is extra 30 lakh what we have received with the order of court. And suppose it has the court order of the court has been come on 1/6/2026. So we are going to tax that enhanced compensation. Now sale consideration would be 30 lakh. No need to calculate long term, short term. The good thing, the cost of acquisition, etc. will also be always nil. Why nil? Because we are receiving compensation in respect of this property. And the cost of acquisition of this property we have already reduced at the time of calculating of original compensation always. So the cost of acquisition, etc. would be always nil in case of EC. Only the court fees, advocate fees, etc. you can deduct like expense on transfer, but there would not be any cost of acquisition, etc. So full value would be the capital gain. So this was long-term cap gain. So automatically this would also be treated as long-term capital gain. So now you can see in case of compulsory acquisition, there is a treatment of original compensation that could be asked in a question. And of course, the question will say that there is some enhanced compensation. Only then the question would be a complex question. So you understood how to calculate the enhanced compensation also. Now the third problem is here. So this question might have three situations to solve in your examination. The third situation is different. Suppose the question say, this was your first, this was your second situation. Now the third situation is different. Suppose the question says that when assessee went to the court for enhanced compensation of 30 lakh. Assessee went to the court for enhanced compensation of 30 lakh. Suppose what happened? Courts rejected it. In the second situation, we assume that court accepted it. Whether court increased by 30 lakh, 25 lakh, 21 lakh, whatever court would decide, that would be your EC. Now the situation has been different. Courts rejected that 30 lakh rupees your application and actually reduce the original compensation. This is the problem. The original compensation was decided 60 lakh. So court says, no, you should not get any enhanced compensation, even whatever you have received like 60 lakh rupees earlier. That is also extra. So you should only get 50 lakh rupees in place of 60 lakh. So they reduced your original compensation by 10 lakh rupees. So now your original compensation should be 50 lakh only. Now this is the problem. Suppose the judgment has come on 1/6/2026, but you have already paid tax in assessment year 25-26 on 60 lakh. Now, how you will be able to pay tax considering your sale consideration 50 lakh? So there is only two views. Either you must have a time machine with you. So you will sit in that time machine, you will go back, you will change your income tax return, you will remove 60 lakh, write it down 50 lakh in place of that, and pay your tax accordingly. So that is not possible. The second is possible. The second thing says, now in assessment year 27-28, you have to recalculate your capital gain. Again, you have to recalculate your capital gain considering or assuming that your sale consideration should be 50 lakh. So you might be thinking this is very difficult. It is getting more and more complicated. So let me tell you, no, you do not need to do anything. You just need to write down the year. Everything else like period of holding would remain the same. 2010, then 20. No change in period of holding. Sale consideration, only one figure you just need to replace. That would be now 50 lakh. All other index cost of acquisition, index cost of improvement, etc., would remain the same. No change. Your gain would be less. But you have already paid tax on 39.66 lakh. But now you need to pay tax on 29.66. So that means you have paid extra tax. So the balance tax, the extra tax would be refunded to you. So whatever extra tax you have been paid, you have to calculate your capital gain tax on 29,66,000. Whatever tax is there and whatever tax you have been paid, the difference is going to be refunded by the government to you. So in case of a compulsory acquisition case, there could be three type of question could be asked. Or that is possible, then the same question, three situation can be asked to be solved. First one is regarding original compensation. Second, they will say, suppose in this case, you are getting some enhanced compensation of 30 lakh rupees, treatment karo uska. Then they might say, suppose in the above case, there is no enhanced compensation and even your original compensation has been reduced by the court. Ab treatment karo uska. So this is treatment is easy. No extra calculation. You just need to change one figure in place of 60. You just need to write it down 50 and your answer is there. What would be the problem in capital gain? The main problem in capital gain question is this. When examiner make a question like this, it will be in a single page. At least one page would be only the question is there. Suppose how it will be that Mr. Ram is a person who has purchased a capital asset in year 1/6/2009 for rupees 10 lakh. That property has been acquired by the government for his project on 1/6/2022. And that property has been compulsory acquired and the compensation has been decided 60 lakhs. So if I am going to write it down, these information in a sentence, in a paragraph form, it will at least cover one page of your question paper. And what is our mentality? If we see a question of this huge, we say, okay, this we want to be able to solve. But you see, the solution is very simple. We are not doing anything. The same period of holding, the same sale consideration, the same index cost acquisition, enhanced compensation, we just need to tax in the assessment year, and so in the recalculation of this reduced compensation. So capital gain is having a very unique character. The question would be large, but the answer would be in 3 and 4 lines. All other heads having a different case. If there's a question of salary of 5 or 6 lines, the solution would be for at least 10 or 15 lines. Same in case of house property. If the question is 3 or 4 lines, you have to solve at least 5-10 lines for the purpose of solution. PGBP, do not talk about it. If the question would be a 1 page, solution would be at least for 2 pages. But for the purpose of capital gain, if the question is for half page, the solution would be for 3 or 4 lines. If the question is for 1 page, solution would be still 3, 4 or 5 or 6 lines having the same pattern. So it looks like capital gain questions are very complicated, But if you will find out the main question contents to solve our question, this is really simple to solve these kind of question. Okay. चलिए फॉरवर्ड करते हैं इसको आगे. Mr. Sahil Kumar is saying, if our part payment of compensation is less than capital gain is computed, what will be the treatment for that situation? Look, for the purpose of capital gain, we have to take the full value. Whether you are receiving compensation 1 lakh rupees, you have to take 60 lakh for the purpose of capital gain cases. There could be a problem that you will take 60 lakh rupees. There would be gain. We have seen in the question, in our question, the gain was like 39 lakh rupees. The tax on 39 lakh approximates 7 or 8 lakh. What do you need to pay? But you only receive, suppose, 5 lakh rupees as a compensation. So if you have 5 lakh rupees, how you would be able to pay 7 lakh rupees? So that would be a practical problem. Then you can go into the court, and court will definitely going to decide the case in your favor. But as per the income tax provision, for the purpose of examination, we cannot do this thing. We have to calculate taking sale consideration as 60 lakh rupees. Okay. So these are the provision. Let's discuss taxability of asset in case of asset compulsory acquired by government. In case of original compensation, whole compensation is taxable in the year in which whole or part of the whole compensation is received by the assessor. Numerical treatment, transfer year will be the year in which property compulsory acquired, but capital gain will charge in the year compensation full or part received. Period of holding would be normal case. There is no difference. Sale consideration would be total original compensation, whether received full or part, less normal cost of acquisition or cost of improvement. That was the treatment of original compensation. Now we have enhanced compensation. Many time person whose capital asset have been taken over by central government or who got compensation from the government go to the court of law. For enhancement of compensation, if the court awards a compensation which is higher than the original, difference thereof would be chargeable to capital gain in the year the same is received from the government. Cost of acquisition in case of enhanced compensation, for this purpose, the cost would be always be nil. Compensation received in pursuance of an interim order deemed as income chargeable to tax in the year of final order. So this is the year in which we are going to tax the enhanced compensation. In order to remove the uncertainty regarding the year in which the amount of compensation received in pursuance of an interim order of the court, tribunal or other authority, the income chargeable under the head capital gain in the previous year in which the final order of such court, tribunal, authority is made. So you can see the treatment of enhanced compensation is very simple. The amount, final order by the court, and cost, etc. would always be nil. Reduction is the third case, what we have discussed. Whether capital gain has been charged on the compensation received by SSC for compulsory acquisition of any capital asset or enhanced compensation received by SSC, subsequently such compensation is reduced by the tribunal, etc., then the capital gain should be recomputed. We have to recompute, replacing the new sale consideration. Death of the transfer, it is possible that the transferor may die because he received the enhanced compensation. In that case, the enhanced compensation will be chargeable to tax in the hand of the person who received the same. That means in the hands of the legal heirs. A provision which says, now what happens generally, because you will receive the compensation late. So for the purpose of that late receivability, in some cases, government also provide interest. Suppose the compensation was 60 lakh. You received it after 3 years. So government said we will pay interest also at the rate of 10%. So you will get 60,000, 60 lakh, 6 lakh rupees per annum as an interest. So 18 lakh interest you might receive. So that would be your income from other sources. And we have the specific provision for that also. Taxation of interest on compensation and enhanced compensation. So whatever interest you will receive in this OC or EC, 50% of interest is going to be taxable under income from other source. The 50% is exempted. Only 50% of that part is going to be taxed. A deduction of 50% from such interest will be allowed and no other expenditure allowed from such interest income and taxable under income from other source. Clear? So that was compulsory acquisition. So somebody was asking something, Nidhi. Nidhi is asking, sir, ये जरिंग तो नहीं है, कोर्ट हमारी बात माने? नहीं, बिल्कुल जरूरी नहीं है निधि कि कोर्ट आपकी बात माने, बिल्कुल भी जरूरी नहीं है। कोर्ट या तो एनहेंस करेगा, या तो रिड्यूस करेगा, या तो कुछ नहीं करेगा। तो हमारे पास प्रोविजन तीनों चीजों का है। अगर कोर्ट इंक्रीज करेगा देन वी विल टैक्स इट एज लाइक एनहेंस कंपनसेशन। ओके, अगर कोर्ट कुछ नहीं करेगा तो हमें भी कुछ नहीं करना। अगर कोर्ट ने रिड्यूस कर दिया तो हमें ओरिजिनल वाले को दोबारा से रिकैलकुलेट करना पड़ेगा जिस ईयर में रिड्यूस करने का ऑर्डर पास होगा। और रिड्यूस होने से अगर हमने पहले टैक्स ज्यादा दे दिया है तो वो हमें टैक्स गवर्नमेंट रिफंड या एडजस्ट करेगी। ओके, Rajveer is saying cost of acquisition and cost of improvement will be nil when court reduce the OC. No, 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 no. Cost of acquisition, cost, look, जब court reduce करेगा, when court will reduce your original compensation, then you have to recalculate your gain again. In that situation, I have solved the example that only the new compensation will be your sale consideration. That in our example, earlier it was 60 and then now court reduced 10 lakh and now the original compensation is 50. So we will just change 50 lakh as a sale consideration. Other things like cost of acquisition, cost of improvement, etc. वो वैसे ही रहेंगी as it was in normal case. Only in case of enhanced compensation, cost of acquisition, cost of improvement will be nil. Okay, Rajveer? Jayendra is saying in assessment year 22-23 received 4 lakh. 4 lakh received as part of OC. In 25-26, 2 lakh received as remaining part of OC. Then there is no treatment for 2 lakh rupees in 25-26. Yes, of course. We have explained this in the example also. That out of 60 lakh, you receive only 40 lakh rupees. But because you took full 60 lakh rupees for the purpose of capital gain, so whenever you will receive balance 20 lakh rupees, the part of original compensation later, that would not have any tax treatment because we have already included the full value when we receive the part value. Correct, Mr. Jain? Okay. Sure. So that was compulsory acquisition we have completed. So there were 3 exceptions of section 45 in which we do not tax that capital gain in the year of transfer, but we defer our tax liability. Conversion of capital asset, destruction, and compulsory acquisition. Moving on further, computation of capital gain in case of market-linked debenture, section 50AA. If you remember, section 50AA we have already discussed under short-term capital asset and long-term capital asset definition. There are certain assets, those would be treated as short-term capital asset always. That we have discussed in section 50AA. So in that cases, how we will calculate the capital gain? Because it would be treated as short-term capital asset. So that means there would not be any indexation. Whatever will be your sale consideration, you just deduct the cost of acquisition. There would not be any indexation. That's how we need to calculate the gain. So you can see this section we have already discussed earlier. Transfer of units of a specified mutual fund, market-linked debenture, unlisted bonds, unlisted debenture. Section 50AA provides for the computation of capital gain in case of transfer or redemption or maturity of units of a specified mutual fund acquired on or after 1/4/23. If it is acquired before 1/4/23, then it could be long-term also. And if it is long-term, then indexation would be done. Market-linked debenture, no indexation. An unlisted bond, unlisted debenture, which is transfer or redeemed or mature on or after 23rd of July 24. So on or after 23rd July 24, there is no indexation concept except in case of land and building, whether these are unlisted bond debenture or anything. Of course. So these are the provisions. Section 50AA will have an overriding effect in spite of anything contained in section 242A that define the short-term capital asset and long-term capital asset. Short-term asset and section 48 that is for indexation. So section 50AA, if applicable, if the asset falls in these of three asset category, no indexation will be done and the asset would be treated only short-term capital asset. These are two overriding effect. Accordingly, capital gain arising from transfer or redemption or maturity link, etc., you can go through with these provisions. They are just simply explaining this thing. How you will calculate the capital gain without giving the effect of indexation. Whatever you receive, that would be your sale consideration. Whatever you have spent on purchase, that would be your cost of acquisition. Balance would be your capital gain. No reduction in respect of STT, security transaction tax. Next is transfer of shares in case of liquidation of company. Now this provision, Shan is saying, sir, can court order the refund of EC? Yes, if court order the refund of EC, then your tax, whatever you have paid on your enhanced compensation will be refunded to you. Court can do anything. Now liquidation of company is having two parts. One part is going to be taxed under income from other source with the name of deemed dividend. In case of liquidation of company, what happens? Company distributes its asset or monetary things to an shareholder. So when shareholder receive these asset or monetary things, that is going to be taxed in income from other source up to a certain extent, up to the accumulated profit. Now, what is accumulated profit? How it is being distributed? How it is going to be taxed as deemed dividend under income from other source, that we will discuss in income from other source topic. So why we are discussing it under capital gain? Because a certain part is also going to be taxed under capital gain. So that's why we are discussing that capital gain concept in case of transfer of share, in case of liquidation of company. So the provision says, in the hands of liquidated company, where the asset of a company are distributed to its shareholder on liquidation, such distribution shall not be regarded as transfer by the company for the purpose of section 45. So in the company hand, there is no tax liability. If company is distributing its asset, etc., at the time of liquidation, there is no treatment in the hand of a company. The treatment would be in the hands of shareholder. The above benefit of no treatment would be applicable if these two conditions are fulfilled. The above section is restricted in its application to the circumstances mentioned therein. The first is it should be at the time of liquidation of company. The asset of the company must be distributed in specie to shareholder on the liquidation of the company. Then company do not need to do anything. If, however, the liquidator sells the asset of the company, resulting in a capital gain, and distribute the funds so collected, the company will liable to pay tax on such gain. So if the directly asset has been distributed to the shareholder, then there is no liability in the hands of company. But if liquidator transfer those assets and realize the money, in that case, capital gain would be applicable in the hands of company. Understood? Now we are focused on the treatment in the hands of shareholder. Shareholders receive money or other asset from the company on its liquidation. They will be charged to income tax under the head capital gain as well as income from other source in respect of the market value of the asset received on the date of distribution or the money so received by them. So whatever they will receive a market value of asset and the money, that could be taxable under capital gain also. But out of that money and market value, a certain extent of value taxed as income from other source and the balance could be taxed as capital gain. The portion of distribution which is attributable to the accumulated profit. Now do not get confused that what is this attributable to the accumulated profit. That things we are going to discuss under income from other source in detail. Of the companies to be treated as deemed dividend under section 222C, refer income from other source. So do not bother about this part. which would be taxed in the hands of the shareholder. The same will be deducted from the amount received or fair market value for the purpose of determining the sale consideration for computing capital gain. So we are actually concerned with this provision, that how to calculate the capital. So the provision says whatever money or market value of asset you are receiving, whatever money at the time of liquidation or fair market value of asset an assessee is receiving, that is your sale consideration. And if anything becomes your deemed dividend, that is going to be reduced out of it. So that is for the purpose of capital gain head. So how we will calculate capital gain? The amount of money received, the amount of FMV of asset you shareholder receive. Out of that value, if we reduce the deemed dividend under section 222C, the balance would be chargeable to tax under the head capital gain. You can see we have made a diagram also. In the hands of shareholder, up to accumulated profit, 222C, income from other source. So that part is going to be discussed in income from other source in detail. Clear? The money received and FMV of asset distributed less deemed dividend, which has become deemed dividend, that would be consideration of section 48 and to be considered for computing capital gain in the hands of shareholder. The company which is in liquidation, what is the meaning of accumulated profit? That we will discuss under income from other source in detail. For the time being, accumulated profit includes all profit of the company up to the date of liquidation, whether capitalized or not. What is the meaning of capitalized or not, etc. That we will discuss under income from other source. Clear? Nidhi is asking IFOC का full form क्या होता है? IFOS है निधि, income from other sources, not IFOC. It's IFOS, income from other source. यहाँ लिखा हुआ है 5 हेड होते हैं ना हमारी इनकम के, सैलरी, बिजनेस, कैपिटल गेन, हाउस प्रॉपर्टी और अदर सोर्स. तो इनकम फ्रॉम अदर सोर्स, इन्फोसिस नहीं होता. ओके, यू आर राइटिंग ऑन इन्फोसिस, नो इन्फोसिस. Fine. So that was the provisions for liquidation of company. Now we are moving on to the other point, and now this is buyback of shares or specified security. So buyback of shares has an amendment up to 30th September 2024. There was some different provision for buyback of shares under section 46A, and on or after 1st October 2024, the provision has been changed slightly. What are the provision? Let's discuss. In case of specified security other than shares, so you can go through with this concept. What is the meaning of buyback? I believe you know what is the meaning of buyback, etc. You can read these provision. Let's discuss the implication of capital gain in case of buyback. So this is the amendment. In case buyback of share affected before 1st October 2024. And let me tell you, if you read this provision, like with this theoretical provision, that might confuse you a lot. So we have made a diagram to make you understand the provision very easily. And after this diagram, if you go back to those theoretical provision, you will understand each and every word of that provision. So what are the provision? Let me explain you with the help of this format. Buyback before 1st October 2024. Fine. Up to 30th September. If buyback of share has been done, then up to 30th September, this would be applicable. And it's very simple. Taxability in the hands of company ke hand mein, what would be the taxability and what would be the taxability in the hands of shareholder? We are discussing if it is up to 30th September. So if buyback of share by domestic company, if it is done by domestic company, then if it is up to 30th September, then company needs to pay tax subject to additional income tax. Whatever amount of buyback company needs to pay tax of 23.296%. 20% tax, 12% surcharge on tax, and upon tax plus surcharge, 4% cess. So this figure would generate 23.296%. Company needs to pay tax if it is up to 30th September. If it is buyback of share by a company other than domestic company, then there is no tax liability. If buyback of other than share, any specified security other than share by any company, whether domestic or other than domestic, if the shares has been buyback domestic, then company needs to pay. Otherwise, if this not share or if it is other than domestic company, then there is no taxability. So you can say that up to 30th September, only in one case company need to pay tax in case of buyback. If company is buying back its shares and it's a domestic company. So if shares buyback by a domestic company, tax need to be paid by the company. Otherwise, company needs not to pay any tax. Both conditions should be fulfilled. This should be shares and that should be domestic company. If these both condition does not fulfill, as you can see, not fulfill in this case, not fulfill in this case, then there would be no tax liability. Because in first case, company needs to pay tax. That's why it's exempted. It was exempted in the hands of shareholder under section 1034A. But in this case, income arising to shareholder upon buyback needs to taxed under section 46(6). Whatever amount company will pay you on buyback, that would be your sale consideration. Company will pay you when company buy back their share, they will pay you tax. They will pay you consideration. So that would be your sale consideration. And cost, etc., you need to reduce as in normal case. So that would be your gain. Same in this case, company need not to pay tax, shareholder need to pay capital gain tax. So that was up to 1st of October. Now what happened on or before, on or after 1st of October? Now the provisions are simplified. In case of company, now there is no tax, no tax, no tax, whether domestic, whether share. So now companies are out of the purview of capital gain tax in case of buyback. But shareholder need to pay tax in case of buyback. So if that is the shares of a domestic company, amount received will be taxed as income from other sources as dividend. Now suppose you are receiving amount 5 lakh rupees on buyback from a company. So that 5 lakh would be directly your income from other source, and capital gain need to calculate, but sale consideration would be nil because full amount has been taxed as income from other source. So your sale consideration would be always nil. Whatever the purchase price of those shares which has been buyback by the company, it need to be reduced. So there will be always loss, long term or short term. That loss you can set off from other income. Clear? If the second case treatment and the third case treatment is same. So you can see whether it's before 1st October or on or after. These 4 cases are same, no change. The change is only over here. Earlier, company need to pay tax. Now company need not to pay tax. Earlier, it was exempted in the hands of shareholder. Now the buyback amount is going to be taxed as income from other source. And there would be sale consideration nil. And there would be loss in case of buyback in the hands of shareholder. Clear? Any query, students? If you want to ask anything, you can ask. So we have completed till buyback provision. Now we will start the provision of capital gain on transfer of depreciable asset. The good thing is you have already gone through with the depreciable asset provision under PGBP. Nidhi is asking सेस क्या होता है सर? निधि, मैंने पहले भी बोला था कि स्टूडेंट्स प्लीज जब आप कोई लेक्चर देखते हैं तो पुराने लेक्चर्स को देख कर आइए. निधि, सेस हम बेसिक कंसेप्ट का जो फर्स्ट लेक्चर था उसमें टैक्स, सरचार्ज, एजुकेशन सेस एटसेट्रा ये सब डिस्कस कर चुके हैं. सो आई पर्सनली फील कि मे बी आपने स्टार्टिंग लेक्चर्स नहीं देखे हैं. सो प्लीज एक बार स्टार्टिंग लेक्चर्स को देखो जिससे ये प्रॉब्लम आपकी सॉल्व हो जाएगी. ठीक है? Okay, Ishan is saying, sir, how will be taxability for shareholder? I will solve that question. Do not worry. I have prepared example in case of buyback of share also and other cases also. So we will discuss that. वैसे you want to discuss about the taxability for shareholder in case of buyback? Priyanshi is saying, sir, feeling so heavy now. Of course, it's CA. It should be difficult. If you say capital gain is easy, so it is easy, but as the quantity of provision will increase, so you will feel that now the complexity is increasing. It's a very interesting thing about capital gain. No individual provision is difficult. If you'll see separately, that section 47 provision, Manjula are difficult? No. The share conversion is difficult? No. Conversion of capital is difficult? No. Compulsory acquisition? No. Every provision separately is easy. But when you have to remember all the provision together, because you do not know in examination which is going to be asked, what kind of question could be asked. So at that time, to retain that knowledge, that is difficult. And that's why this course is called CA. It's not BA. So it's not possible that every student can do this. So those are able to have that retain capacity. And how you can do that? You can do this by revision. Whatever I am teaching in today's class, if you are feeling that it is quite huge amount of provision now or it's feeling heavy, let me give you a very simple trick to remember these provision. You take today's class and try to revise the provision tomorrow. Just you have the notes, just try to go through with the notes tomorrow. You will feel less difficult, less complicated. And once you revise once again, you will feel those provision easy. Abhi to we did not solve practical questions. When we will solve practical question of test your knowledge, illustrations, some special question I will ask you. Then after trying those question or practice, you will feel capital gain is really easy. The problem is not understand the provision because each provision separately is easy. The problem is to retain this provision. So for the purpose of retaining those provisions, there is only one trick and that is called revision. I always say revise twice. That's my advice to make you wise. So please revise. And of course, it's a course which actually make you tough. You have to revise multiple times. So it may be possible that for some student, 2 revision is enough. For some, maybe 1 revision is enough, depending upon your brain capacity, etc. And maybe for someone, maybe 4 revision is enough. So what kind of revision will make your study strong, that you will decide. But there is only one trick and that is revision. You can make short notes, etc. But revision is must, and revision with practical question solution. Only in that situation, you will be able to understand each and every provision very clearly. Okay. Ms. Soumya is saying, sir, loss from buyback can be set off against capital gain. Yes, of course, you can set off your loss. This loss has been recognized by the department. This loss can be set off. From which income you can set off, that we will discuss in set off chapter. There is a specific chapter of set off of losses. But yes, this loss is recognized by the department. Harshada is saying numerical question helps remember. Definitely. I always say that when there's a numerical topic, like let me tell you, if I'll teach you how to drive a car, I'll teach you with a book. I will show you booklet that this is accelerator, this is brake, this is gear, this is the clutch, this is steering. Even if you are going to read every provision of that instrument, what it works in driving a car, would you able to drive it without practice on the road? No. Even you learn those provisions by heart, that I know what exactly which instrument do. Would you able to drive that car on road? Impossible. So when you will be able to drive that car, you have to do that practical thing also. So without being practical questions practice, you won't be able to solve practical topics. So that's why I always say we have to solve practical question also. This is like learning swimming by YouTube sitting on true. So very interesting story also. What happened, एक बारी की बात है कि बहुत सारे फ्रॉग्स ओके मेढक वो एक रास्ते से जा रहे थे और एक बहुत बड़ा गड्ढा था, 2 फ्रॉग उसमें गिर गए, बहुत डीप था वो पिट। एंड बाकी सारे जो फ्रॉग्स ऊपर थे वो उन्हें बुला रहे थे, हल्ला मचा रहे थे कि बचाओ इनको। वो नीचे से भी वो बहुत कोशिश कर रहे थे दोनों फ्रॉग जंप करके ऊपर आने के लिए, बट वो पॉसिबल नहीं, दोनों पूरा ट्राई कर रहे थे जंप करके ऊपर आ पाए, और ऊपर वाले भी बहुत बोल रहे थे कि इन्हें बचाना पड़ेगा, कुछ ये लेकर आओ, कुछ वो लेकर आओ, नीचे उन्हें बहुत एनकरेज भी कर रहे थे। आफ्टर अ सर्टेन अटेम्प्ट, जो एक फ्रॉग था उनमें से, उसको समझ आया कि ये मैं नहीं कर पाऊंगा। उसने बहुत मेहनत करी और कुछ टाइम के बाद ऊपर खड़े लोगों ने भी कहना शुरू कर दिया कि यार ये बाहर नहीं आ पाएंगे। पहले ये बात हो रही थी नहीं बाहर निकालो, फिर बात शुरू हुई कि ये बाहर नहीं आ पाएंगे, बहुत डीप है ये पिट और इससे इनका आना इम्पॉसिबल है, हम इन्हें बचा ही नहीं पाएंगे। और सब बहुत ऊपर से हल्ला मचा रहे थे कि अब क्या होगा, ये दोनों तो मर जाएंगे। तो एक फ्रॉग जो बहुत ट्राई कर रहा था उसने ट्राई करना छोड़ दिया एंड ही डाइड। जो दूसरा फ्रॉग था उसने कंटिन्यू कोशिश करता रहा, लोग बोलते रहे ऊपर से कि ये नहीं बच पाएगा, नहीं आ पाएगा, छोड़ जाते हैं इसको, यहाँ पर बहुत हल्ला हो रहा था ऊपर। बट वो दूसरा फिर भी ट्राई करता रहा करता रहा करता रहा और ऊपर फाइनली बाहर आ गया। जब वो बाहर आया तो सारे फ्रॉग्स ने कहा वाह क्या कमाल के हो भाई, तुम कैसे बाहर आ गए, ये तो बहुत डिफिकल्ट था। तो जो उस फ्रॉग का दोस्त था उसने उन लोगों को बताया कि ये डेफ है, इसको सुनाई नहीं देता। तो जब वो फ्रॉग नीचे था और वो डेफ था तो उसे लग रहा था कि लोग जो ऊपर फ्रॉग हैं वो एनकरेज कर रहे हैं उसे ऊपर आने के लिए, बिकॉज उसे नहीं सुनाई दे रहा था। ही वॉज फोकस कि मुझे ऊपर आना है, एंड ही वॉज सीइंग कि वो सारे उसे शायद एनकरेज कर रहे हैं ऊपर आने के लिए। जो दूसरा वाला था वो सुन रहा था कि दूसरे वाले कह रहे हैं कि अब ये बाहर नहीं आ पाए, तो उसने होप ही छोड़ दिया। और उस होप छूटने की वजह से उसने ट्राई करना छोड़ा एंड ही डाइड। बट द सेकंड वाला क्योंकि उसको सुना ही नहीं दे रहा था, ही वाज जस्ट फोकसिंग दैट मे बी दे आर इनकरेजिंग, सो ही केम आउट। सो इट्स ऑल अबाउट आवर माइंडसेट। मे बी आपकी लाइफ में भी ऐसे रिलेटिव्स होंगे, ऐसे लोग होंगे, दे माइट बी टेलिंग यू दैट आपसे सी ये नहीं होगा, ये बहुत डिफिकल्ट है, उसका नहीं हुआ, आपसे इंटेलिजेंट बच्चों का नहीं हुआ, सो जस्ट इग्नोर दैम। फोकस ऑन योर गोल, you can do it. You can do it. It's not that difficult if you have proper planning and if you are ready to sacrifice things. And if you are focused, if you are sure about it that I want to be a chartered accountant, nobody can stop. Understand? So just ignore others. आप सिर्फ फील करो कि लोग आपको जो इंकरेज करते हैं उन्हीं से मिलिए, जो आपको मोटिवेट करें उनसे बात कीजिए, जो डीमोटिव करता है जस्ट कट इट आउट and focus on your things. You will definitely come out of that pit. And of course, that is the dream and dream will come true. Okay. So moving on to capital gain on transfer of depreciable asset. Let me ask you a question because you have gone through with the provision of PGBP. So I can ask you, in the PGBP, there is a concept of block of asset. You all know that, of course, there is a concept of block of asset. Under PGBP, we consider asset as a block of asset. So anyone can tell me what is the meaning of block of asset? Whether in writing or if you'll say, so I will unmute you. So what is the meaning of block of asset? Under PGBP, how it's defined? What is the meaning of block of asset? Because we need to understand the block of asset to solve the question of capital gain under depreciable asset. In this case, section 50 will explain you. But for that purpose, we should know the exact meaning of block of asset or the concept of block of asset. Okay, Shan is saying many assets of similar kind grouped together. Okay, asset having same rate of depreciation, similar types of asset in one block, depreciation rate is same class, same rate of tax are kept in one block. Group of asset having same character like furniture, plant and machinery. Okay. Asset having same nature is considered as block of asset. No. Asset which fall under the same kind like PPE. No. Not same class, not same nature. It's same rate of depreciation. The block of assets says those are having same rate of depreciation will classify under one block. We will assume it as a single asset. And once an asset comes into the block, एक उसमें language है, there's a sentence in that definition. Once an asset comes into the block, उसके बाद, what is the fill in the blanks? Once an asset comes into the block, it's what is dash dash dash. There are three words after that. Once an asset comes into the block, it's dash, dash, dash. What are these three fill in the blanks? Who will tell me? The same rate of asset would be classified as a single asset. And there's a one thing which has been explained in it that once an asset comes into the block, it's dash, dash, dash. So what is the fill in the blank? Who will tell me? Anybody? Will explain. Mr. Omkar is saying it will continue. No, no, no. Mohammad Farhan saying individual tax system. No, no, no. Once an asset comes into the block, it's dash, dash, dash. Arshada is saying till fully depreciated. No. Written down value is saying by Miss P. No. It's individual identity seized. This is the main thing which explains the meaning of block of asset. So block of asset means same rate of asset having same rate of depreciation. Once an asset comes into the block, its individual identity ceased. That means that asset individual identity finish, it becomes the part of the block. Like we pour water in the milk, so that water would part of the milk. In the same way, if an asset comes into the block, its individual identity C, that means it becomes the part of your block now. If block will go somewhere, asset will go. If asset will go somewhere, block will go. Like engine and the train compartment. So once engine is attached to the compartment, whether engine is going, of course compartments are going, or vice versa. So block of asset definition says once an asset comes into the block, its individual identity ceases to exist. On the basis of this definition only, if you understand this concept, you would be able to understand capital gain in case of depreciable asset very easily. So I have revised those provision to you that the same rate of asset having same rate of depreciation will be considered the part of block of asset. And block of asset means once an individual asset comes into the block, its individual identity ceased. So it will become the part of that assets. For example, if there is a block of asset, and suppose there are asset A, B, C, and D, value 12 lakh. One new asset value 2 lakh entered into the block, having same rate of depreciation. So now we will say now block of asset 1. Earlier block of asset 1 value was 12 lakh. Now we will say our block of asset 1 value would be 14 lakh. Individual value we will not give to the separate asset under income tax. This is the concept. Okay. Now how we will calculate capital gain? Let me show you. Capital gain in case of depreciable asset. So provision says, suppose there are asset A, B, C, D, E. In a block of assets, suppose there are 5 assets. The block value suppose 20 lakh. One new asset also purchased in this financial year, asset F. Suppose the value is 2 lakh rupees. So now our block value is 22 lakh rupees. Now for calculating capital gain, there must be transfer. So now there's a capital asset. Depreciable assets are capital asset. But to apply the provision of capital gain, there must be transfer. So either one asset should be transferred, one or more asset is going to be transferred, or whole block of assets are going to be transferred. So there would be two situations. In case of depreciable asset, there would be two situations. Situation number one, either whole block of asset has been transferred. In our example, there are 6 asset total, 1, 2, 3, 4, 5, 6. So case 1 says either it would be done in this year, whole block of asset has been transferred. Matlab, all 6 assets has been transferred. So we will calculate the gain, etc. And the second option would be, the second case in which we need to calculate the capital gain would be when whole block of asset, of course, not transferred. So either one asset transfer or two asset transfer or 3 or 4 or 5. Even if one asset is remaining, even if single asset has been remaining in the block, the case would be second case. If all 6 asset has been transferred, that case would fall in category 1. So all 6 asset transfer for your understanding 6 asset transfer, that would be one case. 1 to 5 asset transfer, that would be second case. Easy, very easy to solve. The good thing, the gain would always be short-term capital gain. In case of depreciable asset, there is no long-term capital gain would be there. Always treat them as short-term capital gain. So this is the good news, because if that is short-term capital gain treatment, universal rule, then you do not need to calculate the period of holding. You do not bother about the indexation concept, cost of improvement, indexation, everything has been gone, because these cases would fall only under short-term capital gain concept. Now, in case of whole block of asset has been transferred, how we calculate capital gain? So the provision says it's very simple. Sale consideration. Of course, the sale consideration would be of all 6 assets, because we have assumed all 6 assets has been transferred. So the sale consideration of all 6 assets need to be write it down. Then we need to reduce opening WDV of block of asset. Opening WDV, that means for our financial year, 1st April 2024, opening WDV of block of asset need to be reduced. So that means in which value of A, B, C, D, and E would be there. So as per our example, that means 20 lakh. If we assume this is 1/4/2024 value, so need to be reduced. And with that, because once an asset comes into the block, its individual identity ceased. So if all asset has been transferred, then all value need to be reduced. Purchase price of new asset, actual cost of new asset purchase, we can say. So that means F value also need to be reduced. So this could be your short-term capital gain or short-term capital loss. That would be your answer. No indexation concept, nothing. You do not need to do anything. You just need to find which case is applicable, and then your answer would be really easy to solve. Very simple questions. But when whole block of asset not transferred, in that situation, sale consideration of those assets, those have been transferred, need to write it down over here, whether one asset transfer, then one, whether 1 to 5 transfer, then 5 asset value, whatever the sale consideration of asset transfer. But the interesting part is this. For the purpose of reduction, suppose in this example, I assume asset A, asset B, asset D, 3 assets has been transferred. So the consideration of sale consideration of A, B, and D will be given in question. So asset C is there, asset E is there in the block, and F is in the block. But when we reduced full value, opening WDV of block of asset on 1/4/24. Full value exactly need to be reduced as we reduced in this case. Even we are transferring only 3 assets, but we need to reduce full value of block of asset. Why? Because of that definition which says once an asset comes into the block, individual identity ceased. When the block will go somewhere, it will complete block will go somewhere. So even you transfer 3 assets, practically you are transferred only 3 assets. But when you going to reduce the block of asset value, you have to reduce the full value, because block cannot be separated. Even the purchase price of new asset, even F, that's also need to be reduced, because now it becomes the part of the block. So technically what will happen? In both cases, reduction would be equal, but the sale consideration would change, because in first case, the sale consideration is of all asset, and in this case, only 3 asset sale consideration. Then why we make these 2 separate cases? We can learn, because the provisions are same, because now here is the reason that we understood these provisions separately. The provision says, in this case, whether there is gain or loss, that would be your answer. But if whole block of asset not transferred and it result in short-term capital gain, then you will show it under capital gain head. But suppose if this is short-term capital loss, then capital gain provision not happening. That loss would not be treated as short-term capital loss. Ignore it. In case of all asset transfer, whether it's gain, it will be shown in cap gain. Whether it's loss, we will show it in the capital loss. If gain in this case, we will show it. But if it is loss, then we will ignore it. No treatment under capital gain. So gain would be presented, but loss in case of second case should not be presented under capital gain. So in the examination also, you have to calculate if there is a loss in that case, you can cut it down and you can write it down, not capital gain provision, not applicable. I hope it's clear now. Here is the provision. And you can see the case A. Case A is when one or more asset has transferred. In diagram, this is our case number 2. So when one and more asset has been transferred, that means block does not transfer. Then in that case, we will only calculate short-term capital gain. That is possible only when your sale consideration is higher than your block value and new asset purchased value. Case B, when all block of asset has been transferred. In that case, your consideration, expense on transfer, opening WDV, new asset we will distribute, and whatever is your answer, gain or loss, both would be calculated under capital gain head. I hope it's clear now. So that was the case of gain. We will solve this example of depreciation. I will solve it with you in our next class. So you will understand how to calculate, how to present. And after that, we are having slum sale provision that we will discuss in our next class. So let me give you some homework. Let me show you some question. You can take the screenshot. These are the questions we will discuss in the next class. You can take the screenshot. This is question number 1. Question number 2. Question number 3, very easy question. Question number 4. Now they are numerical also. Question number 5. Question number 6. Question number 7. Question number 8. Question number 9. Question number 10. We did not discuss the provision of question number 10 yet. So question number 10, you need not to try. Just from question number 1 till question number 9, you have to try. So we will discuss all these questions in our next session. And we will discuss the depreciation provision also in our next session. And further slum sale, etc. concept, we will discuss one by one. So if you have any query, students, you can ask. Arshida is asking, can we set off capital loss when block of asset not transferred? No, Arshida, that short-term capital loss does not recognized. Capital gain provision does not applicable in that situation. So if the block has not been transferred, then if there is short-term capital loss, it will not be considered as loss. You can ignore the capital provision. Capital gain provision does not applicable in that case. Any more queries, students?
Sir, I have 2 or 3 questions for the students, just for their practice or just for their understanding. So, students, if you have any query, just you can just ask. Then I'll just
ask 2-3 questions from you so that it will be your practice till now, whatever the provision sir has taught you and you have understood. So on that basis, so if you have any query, just please raise your query. Okay, so I'll just share my screen. Students, please participate in these sessions. These are just for your revision purpose. And it is only 2-3 MCQ just for the revision till the provision which we have discussed. I have more MCQ also, but I have included only the MCQ for the portion which we have covered in the class till so far. So I want the answer from you, students. Please participate. In this 4 assets, which of the following is a long-term capital asset? It's a basic one. It's, I guess, in the first class, sir has taught the period of holding. So it's based on that. So just tell me, equity share, which is held for 10 months, land, which is held for 36 months, jewelry held for 20 months, or unlisted debentures held for 12 months. Yes, B. Yes, everybody has given the correctly. It's a very easy one, students. If you see in this question, it can be modified, this MCQ, because land I have given you for 36 months. Okay, but if I put a date of transfer that is before 23rd July or after 23rd July, then your 24 months and for other asset, for land, it doesn't make a difference because it's at 24 months. Either before 23rd July or after 23rd July. But for unlisted debentures, the dates period of holding has changed. Now it's only short-term capital gain if it transferred on or after 23rd July. So that will gonna make an impact. For that, I have a next MCQ on that only. There's a person, Mr. Arvind, who purchased debenture of an unlisted company in April 2022. And he sold them in August 2024. So what is the nature of this capital gain and what is the applicable tax rate on that? Student mention the MCQ also because I am receiving the answer B. So, okay, Nidhi, I got answer C. I got an answer C from Nidhi. Then I'm getting multiple answers, C, B, A, D. Student, read the MCQ carefully. I will ask you the reasons also. I will give an option to unmute yourself and give the reasons of the answer which you are giving. All the answer I have given. For A, I have given only one. I have received only one answer. For D, B, C. Okay, just student, raise your hand who wants to answer. Just explain the reasons of their answer. Priyanshi is saying D, indexation is not applied for debenture. It is more than 24 months. So whosoever is giving the D answer, they have the same reasons or different reasons? Pooja wants to answer. Yes, Pooja.
Ma'am, answer would be B
because yes, Pooja.
पूजा फिर भी नहीं बोल सकते
purchased on after 23rd July. So in this case, 36 months would be applicable, and no, ma'am. So it is unlisted debenture, so short term capital gain. डिवेंचर के केस में हमेशा शॉर्ट टर्म कैपिटल गेन होगा मैम 1 अप्रैल 2023 के बाद में और स्लैब रेट लगेगा यस मैम एंड स्लैब रेट लगेगा क्योंकि ये इट इज नॉट मतलब इक्विटी ओरिएंटेड म्यूचुअल फंड जीरो कूपन बॉन्ड उन 3 केसेस में लगता है मैम
करेक्ट पूजा करेक्ट Because
slab rate and short-term capital gain taxable. B option.
yes, Pooja, correct. Because short-term capital gain के लिए special rates is assigned only under section 111A, which is for listed equity share, listed units of equity-oriented fund and units of business trust. Apart from that, for short-term capital gain, no other rates are specified. And there's an amendment which says कि unlisted debentures or unlisted bond, which is transferred on or after 23rd July 2024, they will be always short-term capital gain. You don't need to see the period of holding, whether it is hold for even 1 day or it is hold for more than 36 months or 24 months. It doesn't matter. It will be always short-term capital gain. And since there is no special rates has been given for short-term capital gain in case of unlisted debenture, it will be taxable at a slab rate. Got it, students?
मैं अभी रेट्स पढ़ा ही नहीं एक्चुअली बच्चों को, इसलिए इसका
That is, yeah, yes, sir. I understood. Because short-term capital gain, I guess 50AA you have, in today's class, you have covered that, 50AA. And now, students, the third question, this is not an MCQ because I want the answer from you. We just now, sir has taught about buyback of shares, that what is the amendment post 1st October 2024. It is just for your understanding ki what is the implication of that amendment and what will be the effect of your tax liability and your, like student has asked about the capital loss, ki what will happen to the capital loss. But for that, first of all, I want your participation. Whosoever who has understood the provision till so far, they just can try to solve this situation and give your answer. Then I will tell you what is the implication of the provisions. What is the amendment actually? DEF Private Limited bought back 1,000 unlisted shares from Mr. A in November 2024. So students, it's after 1st October 2024. So definitely amended provision you have to apply here. The buyback price per share is rupees 1,200. These shares were issued in June 2022 at rupees 500 per share. Mr. A has long-term capital gain of rupees 6 lakhs from the transfer of other capital asset. So first we talk about the buyback of shares. What will be the treatment of this buyback? The student raise your hand if you want to answer or you would just try it. You just want to try to give the answers of it. Okay, I got one answer from Farhan. Taxable full amount in income from other sources as dividend. Farhan just mentioned the amount also. What will be the amount? And this is the half treatment of the adjustment which we have told. Ishan, no tax for company and for shareholder, 12 lakh in income from other sources. Very good, Ishan. Very good, Farhan. But it's a half answer. You have given, both have given the half answer. There will be two implications of this transaction in this case. So you have correctly mentioned that it will be taxable as dividend under the head income from other sources and it will be 12 lakh. That is the amount of rupees 1,200 per share into 1,000 shares. But there will be a one treatment more. So anybody? Okay, that is also correct, Priyanshi. No deduction will be available against dividend income. The gross, net 12 lakh is taxable under the head income from other sources. What will happen about this? Okay, Pooja wants to answer. Yes, Pooja?
Ma'am, in this case, capital gain, in capital gain had also sale consideration is equal to nil and cost of capital is equal to 1,000 share into 500 and no indexation in this case. And short term capital loss.
Very good, Pooja.
Also
But
applicable.
very, very good, Pooja. What will happen, since in this case your sale consideration would be nil for capital gain purpose, you will have a loss. And what will be the loss? The loss will be equal to your cost of acquisition, which is 500 per share into 1000 equity share, which is your 5 lakhs. And this 5 lakh loss, you can carry forward and set it off against your capital loss or capital gain, whether it's short term or long term, as per your the provisions of the act, which allows your set off and carry forward provisions. Since that has not been discussed so far, so I'm not going to that part. It can be set off against short term or long term or both, because that will be covered in the set off and carry forward chapter. So if you have capital gain in that current year, you can set it off. If not, you can carry forward it to the next year to set off against the same head and the same. Soumya is saying yes. Yes, Soumya. Sale consideration will be nil and cost of acquisition, that will be lead to your loss. So in this case, 5 lakh will be your capital loss. So these are the 3 MCQ students just I prepared for this class. In the next class also, based on the topic which we will cover, I will be coming with the more MCQs, because rates of tax has not been covered. So I have restricted, I have more MCQs, but since that topic is not covered, so it's better to be take that MCQ in the next class. So till whatever has been taught in the capital gain, if you have any doubt, students, just ask. Sir is there, I am here. So that, because when you are practicing the MCQ, when you're practicing the question, you can just confidently, you can answer the questions. And in case after, when trying to solve the MCQs or case scenarios or chapters where illustration or the homework which sir has given, if you faced any difficulty, you can bring it to the next class in the starting and ask where your doubt, to just have a clarity of the provisions. So students, have you any doubt, or should we wind up this session for today? Pooja has answered. What about everybody else? Okay, sir, I think we can conclude the session for today.
Yes, ma'am. Yes, ma'am. We can conclude. Sure.
Thank you, sir. Thank you, students.
Good night.
Good night. Good night, students.
Yes, sir. Yes, over. Okay,
Yes.
ma'am. Bye.